In this episode, we discuss the Phase 1 agreement between the US and China, the Eurozone, and what is happening with the Australian dollar, all in the midweek wrap with Bob Mason of FX Empire. Let's start with the main topic of the week, the Phase 1 trade agreement between the US and China. The agreement was finally signed on Wednesday. What can we expect when the details are made public, and how will it affect the markets?
US and China have finally signed the Phase 1 trade agreement on Wednesday. That was market positive for the US at least. There are some concerns, however, across the global financial markets. On Tuesday night, we had news of the fact that tariffs will remain in place through to the end of the year. That's really, turning the screw on the Chinese economy and global trade terms, really. That's not particularly positive for Europe and the Far East. And time will tell how, the economic data indicators begin to show whether there's been any improvement after the reduction of existing tariffs, well, some of them at least. On Wednesday morning, we also heard that the US administration will be able to ban sales to Huawei, another thorn in China's side. So all in all, positive for the US. China are ramping up, agri imports from the US. Economic pressure on China, however, that coupled with, existing tariffs may question whether China will continue to stick to the script through the whole year. Compliance and monitoring, whether China are sticking to the script will be key through the year. Any hint of a renege, expect tensions to rise and the global financial markets to balk at the prospect.
Busy start to the week on the economic calendar front, but has it gone to forecast?
There's plenty of economic data to consider in the first half of the week. The UK and the pound garnered the most attention, however. It was pretty dire numbers actually. The economy slowed to a 7-year growth rate of 0.6% year on year, and inflation slowed to a 3-year low 1.3%. The numbers supported the more dovish sentiment towards Bank of England monetary policy. We heard Carney talk of plenty of scope for the BOE to deliver, and we've heard from MPC members over the last few days as well, talking of the willingness to cut rates should the need arise. Well, those numbers definitely support a rate cut at the end of this month. We've got Brexit uncertainty, economic troubles. The BOE had expected economic data to improve at the turn of the year as Brexit uncertainty shifted, and obviously we had the general election as well. That remains to be seen, and the BOE may not be able to wait. So pressure on the pound for now. So economically, numbers, and elsewhere the stats were also skewed to the negative. We saw Eurozone trade numbers, the surplus narrow, and industrial production come in softer than expected. Out of the US, it was mixed. We saw inflation disappoint a little bit, while manufacturing numbers out of New York State provided some support. But really the story was about the pound and the prospects of a rate cut at the end of this month.
Let's focus on the Eurozone. The ECB president is due to give her speech this week. What can we expect from this?
ECB President Lagarde is scheduled to speak late today after the European close. Her speech comes after the release of the ECB monetary policy minutes later on this afternoon. What are we going to expect? There's unlikely to be too much chatter on any likely easing in monetary policy. There is the ongoing framework review, so we might get some updates on how that's progressing. And we can also expect some negative chatter on Brexit now that we know full well that Britain is leaving the EU and entering the transition period at the end of this month. Lagarde may give her 10 cents worth. Elsewhere, we could also hear some demands for member states to deliver fiscal support. Economic data out of the Eurozone is not particularly spectacular. We did see prelim January PMI numbers come off for Germany from their lows to hit the composite hit 4-month high, but the numbers are still not great. Industrial production obviously wasn't particularly impressive. So ECB needs to toe the line a little bit, can't be too hawkish, but I would expect some demands for fiscal policy support and obviously some chatter on Brexit.
With the bushfire still raging in Australia, how's it looking for the Australian economy and specifically the Aussie dollar? Can we see any movement there?
For the Aussie dollar, there were no major stats out through the first half of the week to provide direction. We saw the Phase 1 trade agreement provide the Aussie dollar with some support midweek. That's the first part of the jigsaw puzzle for the Australian economy, improvement in global trade terms. However, the ongoing bushfires that have caused devastation across the country are expected to weigh heavily on consumer spending and likely consumer confidence. That's raised the chances of an RBA rate cut next month to above 50%. While there are no stats this week to give any indications of the impact of the ongoing fires, we've got consumer confidence and employment figures due out next week. So expect plenty of sensitivity on the Aussie dollar when the numbers are coming out, any weak numbers, and that's really going to ramp up the chances of a rate cut. We might see some uptick in the Aussie dollar, off the back of economic data out of China on Friday. We got GDP numbers and industrial production figures due out. Chinese economy is meant to see some improvement at the fourth quarter, which would be Aussie positive. However, as I mentioned, consumer spending remains key for the RBA. So if there's any material pullback because of the forest fires, then expect the RBA to be at the ready to cut rates once more in the beginning of February.
So thank you once again, Bob, for joining us today. That was the midweek wrap with Bob Mason of FX Empire, and we will see you again next time.